Hi all, good evening. So, first of all, the main perspective of this event and these slides are how investors are looking to the startups while reading the pitch decks, while taking the decision whether we can proceed with the funding or not. So, everything they see in the perspective of one thing. I put invest money in one startup, I invest my time in one startup, how my money accumulate and get back to me as a return of some x 3x 2x 5x. They will expect no in a heavy competitive world. One startup founder or any business came to the world of fundraising. They are in the expectation of getting a fund from the investor and developing their product. They are more keen into that. The investors are the ecosystem partners who they are going to help. So that is a main concept. But one thing, this is a business, so legally, ethically, fairly, everyone have a piece of cake from everything. So one investor try to invest their money instead of investing that in a stock market, or they also have the portfolio, variety range of portfolio, where their money is sitting on the listed companies. The least minimum listed company give a returns of risk free of 12 to 14 percentage risk free. With the minimal risk, it will go to 20 percentage returns. So what the investors really look into the startups are get maximum output, like 30 percentage 40 percentage. Their expectations are that high. So the startups who are all come to the stage and get pitched, so they have a mind open to give that returns to the investor. So this is a both win-win situation. If your company grows, you are happily give to the investor. The investor is happily get it back and invest more money. That is one thing. Next thing is the every fundraising, every validation, every prototyping. What you are doing is reduce the failure rate. The increasing the success rate is another ball game. But main thing what we are focus are reducing the failure rate of the startups. So we have the experience over the 10 years. I will let me explain that. Before going that, this is our general conceptions. After that, if you are going to the funding business and fundraising journey, if you are trying to start your fundraising journey as a founder, you should know what financial sheets you are sharing with your investors or any other stakeholders. You know what they are projecting. Instead of knowing anything in the data, you cannot present to the anyone. So you first will aware of that. Unlike of what background you are coming from, you may come from a mechanical, you are from pure technical, deep tech, anything, but you have to know your numbers. That's a thumb rule. Okay. So myself, I am Anuvind. I am fund manager at Cultivate CIET TBI. We are a technology business incubator, mainly focusing on the sectors like tech, deep tech, embedded IoT, and electronic vehicles. So in Cultivate, we are providing the services like marketing, fundraising, and go-to-market strategy support for the startups. Yeah, we are established in 2016. We are supported by the Department of Science and Technology. So we are in this field in last 10 years. We have invested. So we have the facility to grow on a startup from ideation stage till the scale up and growth stage. Each and every sector of the startups have to go through these prospects from their own or get help from the stakeholders. Stakeholders, what I'm meaning is instead the government bodies, also the incubators, also the other founders, the network of peoples also. Next, from 2016, so we have conducted over 18 cohorts. In that, we have worked with 140 plus startups. Either the incubator, either the cohort, the ecosystem of startups spans up to 140. And the graduated startups, we have funded around 37 startups. Apart from that, we have invested 6 plus crores of seed funding. We have the two types of funds right now, and in that we have invested 6 crores. Apart from that, we have raised the external funding support over up to 100 crores. The ecosystem, how it works is, we have money and we have the ecosystem, and everyone works like that. So we have the pool of investors and invest the money in the startups. So the bridging gap, right? The one startup require fund is 1 crore, but the maximum we can give is 10 lakh or 15 lakh or 20 lakh, whatever number is. But that gap of funds must be come from any one of the sources, right? Either from the startup side, either from our side. So this is a main thing today we are going to say. Like you said, you have some technical knowledge and fundraising journey. You have worked with some fintech startup and helped to raise funds for three more startups in the previous journey. So what really fund like means, one pitch deck can decide what we can do in the future. So every fundraising details and every insight what the investors looking are is in this slide. So before going to the fundraising, there are several number of companies. This is a company format who is for a profit purpose. That there is also the non-profit organization and other non-government organizations also there. But these are the main type of companies which they are going to fundraise. The one thing is proprietorship, the sole proprietorship. One person who is solely in the business, he is a proprietorship. There is no need of any other additional compliances. Just GST and other some more minimal compliances are there to the proprietorship. Another one is partnership. Two or more people required to form the partnership company. The limited liability partnership is a registered partner who got the company, and the limited liability partnership company is a different entity, so they can extend the supports from others, other partners, other internal family members or the external circles. They can raise funds internally. That's I will show in the private limited company. The private limited company is a company which is an integrated and very structured manner, either for the compliances and working, and also for the fundraising. The private limited company is a most suitable form, and one person company. Like the private limited company, this is also one separate company, but it is run by a one sole person. That private limited company minimum of have two directors to run. Then public limited company, the next stage for a company. So these are the funding instruments currently available in the market, which startups can access. One is the equity shares. Everyone is talking about the equity shares. I know you are all aware of the equity shares. What is it means? If you invested in one company, they will give a share back. That is an equity share. And preference shares. This is come in the early stage of startup funding. If your company is in a 1 year old and less than 1 year old or just started right now, so put a valuation to that startup is very low. So in the early stage, if you want to raise the money and don't want to dilute your company huge, so you have to go for a preference shares where you can give a share to the investor. After a period of time, let's say 1 year, 2 year or 3 year, you can convert it to the equity based on that valuation. That is on a preference share. The every shares you have see, and the every instrument you have see here has a lot of compliances behind it, but I try to give an overview of it. The loans, you are all know that venture debts are nothing but debts comes from the other ventures and other IBFC partners, and the debentures like the equities, like we provide the debentures to the investors, and the government grants. So there is several number of ministries, several number of bodies who are giving the government grants to the startups. And incubation funding, the incubation has its own funding and also the government fundings. We are some middleman for the government and startups who can give the fund. And CSR support, the corporate social responsibility. Every corporate and every MSME has to provide their revenue of 2% to the society. That is corporate social responsibility they must do in the annual revenue of their company. And these are the instruments where startup and investors are mostly prefer. The CCD, which is compulsory convertible debt. Once you invested in a company, you have two options, and go for an equity, go for an CCD. CCD means you invest in one company, that shares value can be divided or can be transferred into the equity shares after 2 or 3 years of time. That is compulsory convertible. That share debentures are compulsory convertible. And compulsory convertible preference shares, likewise the preference shares, you have to convert it in preference share in a certain period of time, like I said first. And a simple agreement, that is a safe note we say. So agreement just highlighting the what are the comprehensions we are going to make, what are the investments, what are the terms and conditions we are going to do. The safe note. That next one is convertible note. So CCD is an agreement, convertible note is a proof for that. So previously we saw the six type of companies. So these type of companies can raise these kind of fundings. If a proprietorship cannot give a equity, okay, so they only have the options of go to the loan to the banks or any other funding ventures. So that is a loan and grant. Government grants are the proprietor can take the government grants. And the partnership firms, so the partnership firm can options of going loan, partner capital and grant. The equity option and CCD option is only possible in the private limited.
Buy their shares in a discounted price. If the share is for 1,000 rupees for any other common public, you can get the same shares at a rupees of 100 rupees. That is a best option for the employee. That come along with some terms and conditions and some compliances, but there is an option. And previous investors, like I said, if you have any previous investors, you have to show in your financial statements as well as your pitch decks. So on the future funding roadmap, if you are closing your funding round by 6 months, after 1 year I am starting the next fund round. So that will also give a picture of your growth and your ambition in the fund investors perspective. And if you the valuation method, there is a number of valuation methods. So everyone following in the early stage of a discounted cash flow method. So where you are going to put your projections of your revenue. Based on that, you will evaluate your company. My net worth, like we say, the Elon Musk has an 400 to 300 billion net worth. Likewise, startup also have the net worth. That is their valuation. So based on their valuation, how much equity shares they can give in how much price. That calculation comes from the valuation perspective. To attain certain valuation, you have to fix a milestones. You have to complete that, achieve that milestone in a specific number of time. Value creation plans, how you create the value and that valuation and how you going to create. You see the market and sales and everything and exit pathways. Here the exit is not meaning you are exiting the company, you are leaving the company. That means you are borrowing your money in multiple times. Like in one round, the exit how it work is there is several type of exits like merger and acquisition, the sellout, the buyback. These are the exit and the succession. There is a number of exit strategies is there. The best example for the exit is if you are an investor, you invested in me and my startup. Your 10 lakhs is with me. I am going to raise another round. You are my seed round investor. I am going to invest my Series A. So that round, the other set of investors came in and buy my shares in the value of 2x what the value you have purchased in the earlier stages. So there, they will get the shares in the price double of the prices what you purchased earlier. So you will get the amount of 2x. Okay, the 1,000 rupees of shares what you bought in the previous year, now that's worth in the 2,000. Like that. So this is the sample deck. This is not much, but there is some perspective of how you show your working capital and your utilization in a way the investor can easily point out and easily understand how much less time and the investor spends in and get more value from your pitch deck, there is a high chance probability of getting the funds and closing the deal. So these are the around year and economics. This is a let's say when a product company has one product, they manufacturing a number of unit of product monthly, annually, and year on year their sales growth and selling price and their revenues. And the diagram represent be how we utilize their money, the purpose. So these are the things. How you show that? The what are the things are you are saying saw earlier? That is how you do that. This is what you do that. Okay. Though this is the thing you have to put in the perspective of the investors. How much fund you are asking for your need 5 lakhs or 10 lakhs. We establish your startup and establish your another unit in another base. And what are the reasons? You have to mention the fund. Ask how much fund you are raising in the what are the instrument you are open to accept the funds and what are the fund utilization. These are the small perspective. So year on the quarter wise, you have to split the utilization and achieving milestones. These are the utilization. So this is on valuation report final piece. So on attaining this value, we have to go through n number of calculations, valuations, and market studies, market trends. We have to study them. So to attain this, we have to fix the valuation. Let's say the company is value for 5 crores. Then the number of shares is 50,000. Okay. Then one share value is 1,000 rupees. So these are the calculation used to come to that valuation. So you can just go into the ChatGPT like we say. So input this number of these words enterprise value and terminal value. They will see how you get to that. So they will give you supporting documents which you can study. Before going to raise any funds, the founder must know what their company is really worth. Okay. So you have to, there is a n number of inputs there. They have to n number of things you can consider before come into this value. Okay. This is purely a sample slide. So this is an investor perspective. This is a cap table after funding. Okay. This is a company which have the 50,000 equity shares splitted by their founders. Like 23,500 is for one founder, 26,500 for another founder. See the percentage. The 53% held by the Mr. X and 47% held by Mr. Y. This is post funding, the pre-funding. Before going to funding round of 5 crores, this is their cap table. The investor didn't invest any money, so they 0%. After investing their 15 lakh, since we know the one share value is 1,000 rupees, for 15 lakh we will get 15,000 shares. So here you can see the number of shares remains the same, but percentage declines. Okay. So why this is happening is we are only have the 100%. The number denominator increases. There is a change in. So the 2.91% for 1,500 shares. So how this is okay is the company is valued at 5 crores. I invested my 15 lakhs into the company. In return of that, I get the 15,000 shares. Okay. So 1,500 shares. And the shares in the company is 2.9. 5 crore valuation. And I putting the money and get the equity shares. So now my value or my holding in the company is 2.9% in the 1,500. Why we are just take the shares from the investors instead of creating the new shares? The 50,000 shares jumps into 51,000 shares. So why we are doing that is These shares are held by the individuals. If we buy the shares from them, the money will go into the founders, not to the companies. So the only way the company will benefit is increase the shares and give it to the investors and get money for themselves. Okay. So this is how the money works. The pre-money valuation says the pre-money investing, before investing, that is a 5 crore company. Now with that, this 5 crore 15 lakh company. Okay, how many investment you are getting, that is a post money value. So these are the some government schemes currently available in the market which startups can access now. The Startup India Sequence scheme, if you are not apply so far, the deadline is May 15. Before that, you have to apply. So other departments, a few of them, there is an n number of ministries and they are calling out for startups to submit their proposals for get fundings. So these are the some of departments and some of the schemes currently available in the market. Yeah, thank you.